Inflation in Canada holding steady at 1.7% year over year in May. Shelter costs cooled, especially in Ontario. Our guest says a continued slowing in core inflation will be key for the Bank of Canada to cut rates at its July meeting. Let's bring in Veronica Clark, economist at Citi. Veronica, great to see you. You think broadly that the bank is likely to cut next month, cut rates again?
Yeah, it depends very heavily on this inflation data. We have one more CPI report to go before that July decision, the report for June that will come out next month. There has been a lot more focus on the stickiness that we've seen in the core inflation measures. So I do think it's maybe a necessary condition that core inflation in June data is back in that target range, below 3%. But I think it's pretty likely right now, at least my forecast is that it will be back in that target range. It does seem like some of the details, even in this May data, were a bit more favorable, that slowing in shelter inflation mainly.
We're looking at a chart now of the core interest rate and inflation, and we can really see how they missed the boat in the pandemic-inspired inflation. They took their sweet time about raising rates.
Yeah, absolutely. And you do try to be forward-looking, as a policymaker setting the policy rate, but the Bank of Canada explicitly is not being very forward-looking right now. They've told us that. Of course, there's just a lot of uncertainty around tariffs and the growth outlook. They're not being as forward-looking as usual. But I think in July, when we start to get forecast updates again, as usual, hopefully, then they can go back to being more forward-looking. And it does seem like there's more downside risks, I think, to inflation this year than upside.
Tell us what's been happening with shelter costs, because mortgage rates have been falling, actually, with interest rates, mortgage costs, and rents have shown signs of coming down as well.
Yeah, absolutely. The shelter outlook looks a lot more favorable than it has for the last couple years. The way that we measure shelter inflation is a little bit different in Canada versus the US, but mortgage costs have been an element within shelter inflation and CPI in Canada. So those coming down, that's helped. But we have seen rents slowing, and part of that story could be softer immigration trends this year, less upward pressure on those rents. But then also, very importantly, home prices have been falling, and that is a direct input into shelter inflation in certain components in CPI. And so that weakness that we've seen in housing is going to pretty quickly feed into softer shelter inflation. And I think that trend should continue based on what we've seen so far in housing data.
So inflation less than 2% now. So the Bank of Canada must be feeling pretty comfortable.
Yeah, partly we have to be a bit cautious on that headline year-on-year reading. In the April data that we got a month ago, there was the end of the consumer carbon tax, and so that is lowering mechanically that year-on-year rating for a while. That just dropped out in April. So the core inflation measures, which are right around 3%, are probably the better indication of underlying inflation trends, although I think they also have some measurement issues, maybe related to shelter having been so strong for so long. It does seem like the stickiness even in core inflation is in shelter, but we do know that shelter should be slowing with housing much weaker. So I think the truth is maybe somewhere in the middle of that, around 2% headline, but still 3% core.
That's so sorry, just the core has remained sticky. It's been stubborn.
Exactly. Yeah, the core measures, the CPI trim and the CPI median, they come out the same time as the overall headline CPI rating. Those are averaging 3% in this reading for May.
What are you looking out for as we move into the second half of the year? Obviously, tariffs create massive uncertainty for companies, but companies, of course, do like to increase prices when they can, and tariff costs, supply chain disruption gives them cover to do that.
Yeah, potentially, but increase costs when they can. I think that's a really important issue. Is they might not be able to. It just seems like demand might be too soft that you really can't pass on some of these tariff costs. Certainly, other costs look better. Wage growth has been slowing. The Canadian dollar is a lot stronger now than it was a couple months ago. So there are reasons I think to see inflation slowing. The second half of the year, I wonder if maybe the surprising, dynamic for the economy might be more slowing in the U.S. and maybe a Fed that is even cutting sooner, and maybe that gives some cover for the Bank of Canada to feel a bit more comfortable cutting rates again too. But all of that just points to maybe even softer demand in North America generally, and less ability for inflation to really pick up sustainably.
I have to ask you, Veronica, in your own personal experience when you go shopping, has anything jumped out for you? Any price increase jumped out for you that you've been horrified by?
No, not really. I'm based in New York, so I don't know what the situation is like in Canada. But even in New York, I haven't really seen anything, and certainly we haven't seen necessarily the tariff impact showing up in the U.S. inflation data either. Which I would think if there were to be supply chain disruptions and higher input costs as a result of U.S. tariffs on countries other than Canada, I would think we would see that in the U.S. data before we would see it showing up in the Canadian data, and it doesn't really seem like there is much in the data just yet.